Good morning and welcome, Patriot Radio News Hour. I'm Joe Jaquint, CEO of the Patriot Trading Group, and our toll-free number, 800-951-0592. The website at allamericangold.com. And got Thanksgiving around the corner here, so we are closed Thursday and Friday. So allamericangold.com, you can order all of your needs all holiday season long, 24 hours a day, 7 days a week. So make sure you keep that in mind as we get ready to enjoy family and friends this holiday. I hope you all have a wonderful Thanksgiving. We got one more show tomorrow. Then Patriot and the radio station will be closed Thursday and Friday. We will be back on Monday, and if you leave a voicemail or what have you over the weekend, we'll get back to you on Monday. And Jason, it's a quick, short week here. Still a lot of activity brewing in the markets as well. The crypto carnage continues. Bitcoin down to 15,000. Ethereum is getting ready to break 1,000. As several more crypto exchanges warning about possibly having to file for bankruptcy, and possibly, at least the word today, is the unknown central bank buyer. And I don't think this will surprise any of our listeners. It appears that China is the one that was buying all of the gold. If you remember, last quarter was an all-time record high quarter for central bank gold buying in a single quarter. 400 metric tons of gold bought by central banks. The problem was only about 90 tons of that got declared. In other words, central banks can buy gold and not have to tell that they did it. We know they did it. They don't necessarily have to tell they did it. And Jason, this was on the tune of about there's 300 metric tons not accounted for in this quarter for the year. For the year, they bought almost 700 metric tons for the year, and when, of course, we still had a whole quarter to go, that's the highest single yearly total going back all the way to 1967, and word today is that it appears that it was China doing the bulk of the buying.
You know, it kind of makes sense because, most of the news we get, I always have a suspicious mind to it. But as the physical markets have been getting tighter and tighter, Joe, because there's for countries and central banks, there's ways of hiding the way you purchase these things. There's always a broker, right? You can always have a middleman so that nobody really knows where it's going. But as the supply gets a little tighter, Joe, it gets a little easier to figure out where this stuff is going, doesn't it? It gets a little easier. So I think what you're reporting is probably very accurate. Somebody figured out, hey, even though I sold it to this guy over there, that exact amount of gold ended up in China. I think people are keeping tabs on these orders a lot closer, Joe. And so, China can't hide it as well as they probably did a couple years ago.
And this is going to be a very interesting development here, because this is something where this is on an unprecedented scale. You think about Nixon closing the gold window and how much buying was happening then when he closed the gold window, because Nixon closed the gold window because we were going to run out of gold. People don't realize, and I think on purpose, they don't want people to know their history, but the United States had over 8,000 metric tons of gold in their coffers after World War II, of course, obviously they took a lot of that from the citizenry, when they confiscated gold in 1933. But Jason, that number went all the way down to 8,000 metric tons, and now we're seeing that central bank buying is surpassing even that level when we felt it necessary to have to close the gold window. And I'm just curious what these final numbers are going to look like. I mean, are we going to see central banks buying 1,000 metric tons for the year in 2022? And what does that really mean going forward into 2023 and 2024 and beyond? And, of course, the digital currency. There's a lot of factors at play here.
A lot of factors at play, Joe, but what really boils down to is obviously the physical ounces that are moving around, right, Joe? That's what's going to. I love talking when these countries or these central banks of these countries are buying this huge amount, but yet they constantly have been beating the drum for decades about how you shouldn't touch this stuff, right?
Well, and let's face it, these are not the times that the central banks want to admit to, because what these banks are saying, what these central banks are saying, very simply is, I rather own gold than your fiat currency. I rather own gold than dollars. And that's what's happening right now. And of course, China, Japan, they've been selling dollars like crazy, and I think that's going to continue. Patriot Radio News Hour will be back right after the break. 800-951-0592. Joe and Jason, Patriot Radio News Hour on this Tuesday. So it appears that the Chinese have been bulking up their gold holdings at a rate, honestly, the world has never seen before. It'll be interesting, I think, if China is going to decide to officially make the announcement or not. But Jason, you brought up a good point. It really wasn't too difficult to figure it out, because the one thing that they couldn't hide was the amount of inflows in gold coming into the country, where it was pretty easy to say, oh, China just imported a record amount of gold into the country. Looks like they must have been the ones doing all the buying.
Correct, Joe. Correct. Yeah, it's like I said, there's ways to hide anything that you're buying. You can change the avenues on how it gets there, but if there's an order for so many tons that goes to a broker, and then that same amount of tons ends up in China, the guy that sold the gold knows where it ended up. You know, as long as those numbers of gold ounces are being reported at any length, honestly. But I think in the past, Joe, I think a lot of this stuff was probably hard to track. I think China's gold, what they're sitting on is probably hard to determine, because they try to keep everything very quiet. China's one of the last governments that actually try to hide what they're doing better than the other countries, Joe, that seem to act like they're enemies, but they still sort of do business, right?
Listen, I just want people to understand, what does this all mean? Why, and I know a lot of you, well, why is it gold 3,000 or 4,000? It will be, don't worry. Because, again, the same thing that's going on in silver and gold, they're the exact same. We have record demand. Record demand. And we'll get to silver here in a minute, because silver, record demand this year. All-time record high, and that's saying something, because we had some big years in silver in the last 15, 20 years. Investment demand, record high. Central bank demand, record high. When we're talking physical demands are record high. The only thing that isn't is the paper gold and silver ETFs. And again, that has a lot to do with the paper price. And think about, who are the people that buy these paper gold and silver ETFs? These are people that are just simply saying, well, you know what, I'm looking at the Fed raising rates, so that means stronger dollar, so that means I should sell my gold and silver ETFs. That's really all that trade is. And it makes sense. It's not a bad trade. It hasn't done great. Obviously, gold and silver are not getting hammered here. But you can understand the logic behind it. And here's what I think is interesting and why it is. Why are we seeing such demand this year? Because we have seen central banks buying gold in 2008, 2009, 2010, 2011, 12, 13, 14, 15, 16. I mean, they've been buying gold for the better part of a decade and a half now. This isn't new. But why all of a sudden are we seeing record volumes? And it's a lot more than just China. I mean, think about this year. We're going to be talking about somewhere around 1,000 metric tons. Well, maybe China's bought in 300 of it. That's still 700 metric tons everywhere else. And I think the answer is pretty simple. We are going to see a couple of things happen in 2023 that are going to be very, very important. Number one, we're going to see the end of the rate hiking cycle. Now, we don't know when that is, right? And Jason and I, we're more of, hey, it's going to be springtime and maybe even early summer before that happens. Right now, I think it's going to be May. But it could be January. Could be March. Right? I mean, I guess it could be July. But that cycle is coming to an end. That means ETF people start doing what? Well, they start buying paper gold and silver, right? Because that's the end of dollar strength. I think something else is going to happen. The end of quantitative tightening. And the funny part is you're like, well, man, we just started quantitative tightening and we're already struggling. I believe that is coming to an end. That is another huge sign of dollar weakness. More paper ETF, gold and silver buying. And Jason, that doesn't count if we start lowering rates, and that doesn't factor in if we start quantitative easing again, because at least in recent memory, that's been the pattern.
That's right, Joe. You're talking physical gold and silver versus paper gold and silver. I mean, I'm almost to the point where we should just have our own spot price. We should have the Patriot trading spot price. We just take whatever the spot price is for the paper markets and just add $200 to gold and add $10 to silver. And then when that would put silver at 31. Then if we sell silver at 29, then you're buying below spot, Patriot trading spot. I'm at that point. When is the physical market just going to bring up their own spot price? Gold at $19.50. Wouldn't that be a more logical spot price, Joe, for buying and selling? That just seems more logical for where we're at, because the paper markets, like you say, Joe, it just manipulates the actual cost of what it is. Because obviously, with these premiums been up since 2020, they've lost track of the paper price long ago.
Well, and again, I think it points out things, and why I said earlier in my little spiel here, I think the paper ETF market is probably acting in a logical way as far as, they're not wrong, right? We've been raising rates. I mean, we went from 0 to, and we'll see where we finish here, but we went from 0 to well over 4%. Let's call it 4.5% in a 9-month period. So I guess there's some logic behind it, but I think what we're seeing is all these central banks, they want to do two things. Number one, they want to get out of dollars. Why do they want to get out of dollars? Why are they wanting to get out of dollars so quickly? And I think because the realities are they know these digital currencies are coming and these dollars and all that. Who knows what the value is going to be? Because we know the Federal Reserve note, the cash, that'll go to 0. They'll obviously have accommodations for the treasury markets and foreign currency reserves, but we don't know what that looks like. So they're in there buying gold, and then I think what they're saying is 2023 and 2024, the next 2 years, could be very, very big years. Think about what I just said. We stop raising rates, we end quantitative easing or quantitative tightening. Very, very possible. I think it'll be done, but I think our central bank they're not very smart. Very, very possible that either in 2023 or more likely 2024, that the Fed tries to lower rates and the Fed goes back to quantitative easing, not because they want to, but because the treasury markets don't have enough liquidity to support all the debt that needs to be refinanced, Jason.
Yeah, that's exactly what's happening. We can look at recent history as to why gold will go up in that time frame under what Joe's saying, which is 40% of all the money that's in circulation today was printed in 2020. So gold hit a record high in early August of 2020. That's when the money printing was happening. So if they reverse this and they start throwing some money around, let's just say middle or late 2023, Joe, that's going to be the difference between when I came on board, we were selling $20 gold pieces for $1,300, $1,400 coming into 2020. We were selling for maybe $1,500. Now we're selling for over $2,000. That's 30%. Can you imagine if gold goes up 30% from where it's at now? It's just the spot price. That'd be another $600 on the spot. You'd look at $2,400, $2,500 gold next year, Joe.
And I think they're going to use that number. I think they're going to use that number as these central banks are bulking up these reserves to give credence to their digital currencies. And I think this is what we're going to see. And again, I don't want to I guess I want some people to understand the fact of the matter is because of these paper ETFs, which kind of help with determine what the paper price of these metals are going to be, the logic behind where the price is now. Is it good logic? No. Right? Why are we raising rates because everything's so strong? No, we're raising rates because they printed too much money. And then look at the demand side of things, because the ETFs would tell you that demand for gold and silver should be tanking, and it's the exact opposite. Matter of fact, not only is gold all-time record high, silver on pace to hit record levels in 2022, driven by new highs for physical investment, new highs for industrial demand, jewelry, and silverware production. That's pretty much all of the silver, categories outside of paper ETFs, Jason, and they're saying all of them are going to be at record highs.
Wow. Well, there it is, Joe. I mean, that's what you've been talking about this whole segment. That's where it's headed, Joe. This is the reality that we live in, Joe. So I see gold at 3,000 next year as not being far-fetched at all, Joe. I could see it higher than that. Yeah,
and I guess the big caveat for all of this is be careful what you wish for, because I know a lot of people, and I fall into this. I get frustrated sometimes because obviously when we're paying these ridiculous premiums and they're trying to tell us spot silver's $21 it's today, that can be frustrating. But I think what the message really is you better buy it now, because come next year, your opportunities to buy at lower prices are not going to be there, because the physical demand is there. The investment demand is in forms of ETFs. I think all the stars are aligning for massive flows into those ETFs next year and into 2024. I think we're going to end up, put it this way, I think before 2023 ends, we'll probably have record levels of stock in paper, gold and paper silver ETFs to go with this record level demand for both of the metals as well. And Jason, at going to be, and I think some of these levels you're talking about are not only realistic, they're more than likely. Can we see $2,500 to $3,000 gold? Absolutely. Silver prices, are we going to see a run towards all-time record highs? Of course, that's, you're talking $50 an ounce, and we're sitting here, like I said, just over 21. But to give you an idea of demand, 1.2 billion ounces of silver. Jason, that's 16% higher than the numbers in 2021. And if you know anything about industrial demand, when we know about, this green energy and all this other nonsense, industrial demand makes up more than 60% of all silver demand, and that number is only going to get bigger. 800-951-0592, Patriot Radio News Hour. We'll be back after the break. 800-951-0592. Gold and silver are both higher today. We've had sales going on all week. They continue. $20 gold pieces at $2,095. Cases of Silver Eagles at 19,000. Rolls of Silver Eagles at 770. Dimes and quarters. I don't know that we're going to be able to make the holiday weekend with the dimes and the quarters. Premiums have shot up on these once again, but at least for today, the dimes, and I want to make sure I get it right here. The dimes at 120 and the quarters at 240. We'll see how it goes, but today, that may be the final day on those two items. Silver Eagles right now, unless there's some big move today. And again, silver's up pretty good today, back above $21, $21.10 to the ounce. I'm hopeful that will be able to remain through the weekend. And then on $20 gold pieces, I think the question will be, whatever gold does tomorrow. If gold's higher tomorrow, then we probably got to go higher. But if gold can stay about where it's at, then hopefully we can run that through the weekend, Jason.
Right, and markets are open on Friday, Joe?
You know what? I don't know. Yeah, the gold and silver markets will absolutely be open. I don't know if the U.S. stock markets are going to be open, but obviously gold trades all over the world, so there will be trading on Friday. And again, if something crazy happens, obviously we'll be forced to adjust those prices. We'll just have to see how it goes.
So allamericangold.com. That'll be the important thing Wednesday or Thursday and Friday into the weekend. Make sure to check the prices because whatever special we may have going into that holiday, you might be able to take advantage of a good buying opportunity if the prices move up a little bit and Joe doesn't change the prices, right?
Yeah, you know what? That's always a good way of looking at it. And let's face it, think about when I started here, the gold buyers, they were the weirdos in the family. That was your crazy uncle, right? Maybe that was, oh, yeah, my grandpa, he's, Great Depression type, blah, 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 or the guy, he lives out in the middle of nowhere and all these things, and don't listen to anything he says, and, all that, and I know a lot of you can relate to that, the tinfoil helmet wearing individual. That's not the case anymore. And, that may be an opportunity over the holidays to, hey, Let me show you. Here, let's jump on allamericangold.com right now and let's get you started in the gold and silver markets. Things have changed a great deal when it comes to how gold and silver is looked at from where it was, say, back in 2003 or 2004.
That's correct, Joe. That's absolutely right. And more and more people are starting to figure this out. I still think, I don't know, what percentage of Americans really even own gold, except for jewelry, Joe? It's
probably
still low.
1%.
I think that's
maybe
about right.
2. Maybe we're up to 2.
I think 2%. Yeah, there is, you see the people going in and out of the pawn shops and buying and selling it, and don't ever go to a pawn shop to sell your gold. You go to us to sell it, but there seems to be a little more of a swell of people trying to figure it out, Joe. You said when times get a little lean, like they're getting right now, people start to figure out where value is.
Yeah, and again, the Treasury markets, things are not going well right now. I probably give you a Treasury market report maybe once a week about some bad auctions that we've been suffering through. But as the Federal Reserve is trying to sell their balance sheet, central banks are saying, you know what, we've already got too many dollars. We need to sell some. We need to get rid of some. We don't know when the United States may decide to punish us, right? Let's face it. We've used the dollar. We want you to have the dollar be the reserve currency, but then we want to punish you if you don't do what we say. And Jason, that's had some very negative connotations now, but the Treasury markets continue to suffer from liquidity problems, and they're starting to say that the more likely scenario is that quantitative tightening is going to have to end much sooner than people actually anticipated, because the central bank, well, let's just face it, there's just not enough buyers.
No, I don't know who would want to buy this stuff right now, Joe. I mean, I know the interest rates are going up. I guess that helps. It does it a little bit, but there's too many sellers, not enough buyers. I mean, are we going to see a place where the Fed just doubles their balance sheet in the next few years, Joe? Are we going to see 18 trillion?
Well, we are. They just did. Well, they did already, right? How many times have they doubled their balance sheet now? It's pretty amazing. They had a $700 billion balance sheet. Then it went to over $4 trillion. Then they did their supposed quantitative tightening the last time, and they were supposed to get down to 2.8 trillion. Instead, Jason, they ended up at 9 trillion. Instead of being 2.8 trillion, they ended up at 9.
Correct. And it happened very fast, didn't it? That was fast.
So fast. And I think the biggest takeaway out of all of this is the fact that there doesn't seem like there's a good end here. I wish there was. We've collected record levels of taxes, and yet we're still, think about this, they celebrated a $1.4 trillion budget deficit last year. They celebrated that. Look how great we are. $1.4 trillion. And of course now they have no hope of repeating that. Right? We're going to see a budget deficit north of $2 trillion again this year. And Jason, the problem is now all of a sudden, there's really, forget about the 10-year note. Right now the 10-year note is below 4%. It actually has gotten below the Fed's funds rate. I didn't even know that was possible. But it's actually done that. And you know what's even more amazing is now the spread between a 2-year note and a 10-year note is at a new all-time record high. And that's not a good thing. We'll talk about that next. 800-951-0592. We're talking gold demand. We're talking silver demand. by the way, on silver really quickly, India has emerged as a major silver player. Now, of course, India very well known for their gold, but silver now becoming one of the fastest growing imports in India as well. So, again, more fresh consumption coming into the gold and silver markets, but we're talking about treasuries. And this is really going to be critical because most people that actually understand the treasury markets and what the Federal Reserve has been doing, everybody really knows that it's impossible. What the Fed says it can do versus what it can actually do, it's two different things. And the fact that they're sitting there trying to convince people that they can somehow shrink these balance sheets is really just nothing more than really good, I guess, PR. It sounds good on the television, right? Because they don't want the American public, the generally dumb public, to know what they're really up to. I mean, think about how long they denied that they were even looking at a digital currency. They're making comments like, "Oh, that's ridiculous. We would never do something like that." And of course, we find out later not only were they researching it, we now know, hey, this has been the plan all along. And so when we look at the bond market right now, the 10-year note right this second is at 3.78%. Here's the problem. The Fed's funds rate is between 3.75 and 4%. If you go to the Fed's website right now, it will tell you that the Fed's funds rate is 3.83 right now, which means the 10-year note is actually trading below the Fed's funds rate. On top of that, though, so that's already a bad sign, right? That just is Wall Street's way, the bond market's way of saying this is the most hated Wall Street rally of all time, right? This is a rally based upon, well, let's call it what it is, based upon complete nonsense. This is what the bond market thinks is going to happen. They think there's major pain coming in 2023. But then you look at the 2-year note. The 2-year note is above 4.5%. It's more than 75 basis points higher than the 10-year note. And, of course, we call that inversion, yield curve inversion. And, Jason, this is the largest yield curve inversion that the bond market has ever seen. And, again, that's not a good thing.
Yeah, let me stress what Joe said. One of the things I was going to try to bring on the air yesterday was because it's becoming very it's just a huge thing sitting there, right? Inversion of the yield curve always shows up before market crashes. Not every single time. I guess you shouldn't say always. It happens almost every time. This is the biggest one ever. Joe said it kind of. Joe usually has the emphasis. He usually scream it out. This is the biggest ever. The biggest yield curve inversion ever. Joe, we keep talking about possibly the biggest depression or the double depression. I think the biggest yield curve might be an indicator of the biggest, market stress we've ever seen. I still wonder if we've seen the highs in the S&P and the Dow and the NASDAQ for 20 years. I'm wondering if we're in a third phase since the 1900s of having 25 to 30 years before the Dow makes it back to its all-time highs, Joe. We might be starting into that.
I'll just say this. The signals are clear. Get your gold and silver put away. Period. right now. There's not a better time. The bottom is in. You didn't catch the dead bottom. So what? Pretty close, right? $20 gold at $2,095. I can't wait for the show next Thanksgiving because we'll probably be. My guess is, Jason, we're going to see a number that. I hate to say it, with premiums and everything else, I mean, you could see a number of $1,000 higher than what we're seeing right now.
Yeah, the only thing that would stop that from happening is a lot of monkeying around to slow things down. It's an inevitable situation. It's going to happen. It's not an if, it's a when. I think it'll happen by next year, Joe. Just the way it's looking, if they back out of this rate hike cycle, I think February is the last time they hike the rates, and I think it just blows up. Then, yeah, I think Thanksgiving next year you could see record high gold prices. We could be selling gold for the most that Patriots ever sold gold for next Thanksgiving.
Yeah, and I think that's unfortunately the scenario that I think we're going to be in. Is new record high pricing all over the board. And it just makes sense because, and again, you watch the bond market, that kind of makes sense. We talked about why it is that the paper price isn't reflecting, and you can, whether it makes sense or not, you can say, okay, I guess I can see the logic in that, but the logic in that, all of that logic's coming to an end. 800-951-0592, Patriot Radio News Hour, final segment coming up. 800-951-0592, Patriot Radio News Hour. Joe and Jason wrapping up this Tuesday. We've got one more show before we close for the Thanksgiving holiday. Keep your eyes on allamericangold.com. We got gold up here about $5 now, $17.45. Silver's up 20 cents here, $21.20. The Dow, the most hated rally in history. The Dow is up over 200 points, and right now, if the 2 and 10 year spread finishes where it is, it will be the most deeply inverted Treasury spread going all the way back to Paul Volcker when the Fed's funds rate was 19%. Jason, this just tells you the amount of stress that there really is, because this is how it works, isn't it? Look at the Bitcoin disaster. And I say Bitcoin, it wasn't Bitcoin, whatever, FTX. Everything was great. Right? Right up until it wasn't. And this is the same thing that's happening in the equities right now. They want you to think everything's great. But underneath it, the important part says something is terribly wrong here, and they're saying it's so wrong it is the biggest inversion going back to Paul Volcker. Jason, It's insane.
Well, you know what?
Insane.
Do you know what I think we may see next year, Joe? We may see a complete, just like an inversion in the yield curve, we may see an inversion in Fed policy, meaning this. You hike the rates, and then when things get tight, too tight, they lower the rates and print. I'm wondering if we're actually going to see something different next year that we haven't really seen, which is, hey, they think they've got a hold on the inflation. They lower the rates and start printing. And then the inflation starts flaring up so bad that they reverse policy back to hiking rates. Let's just say Fed funds rate's 5%. They get it down to 4%, and the inflation takes off. And then they reverse back to tightening. I wonder if that will be happening next year, Joe.
Yeah, and a huge about face in Fed policy. I don't know. That's I would say this. That is a more likely scenario than the Fed finding any type of soft landing or any type of hey, we just had I guess we'll call it a mild recession. I don't think those scenarios are likely at all. So you could be right, Jason. The most likely scenario may actually be the central bank saying, holy smokes, it's so bad that we've actually, despite inflation and everything else, not only do we got to stop raising rates, heck, we actually got to start lowering rates. That would be I guess if you want it, and that's not good. Listen, I don't want that to be the case because that will be horrible. Would that be record high gold and silver prices? Absolutely. Do I want to see it? Absolutely not, Jason.